Marina here from Sage Investors, and I am here to do a quick mind map analysis of emerging market ETFs. For those out there, there's also this video you can also listen to it in podcast format through my website sageinvestors.ca, as well as through Apple Podcasts. Just do a search for Sage Investors. Now, one of the things I've been considering incorporating into my portfolios, my personal portfolios, is getting some more exposure to the emerging market space. These are a long-term, I think, the nature of the countries, of the companies, and the companies that are in that space, specifically from Brazil, China, Russia, India, South Africa. These are growing economies and rapidly growing economies that are having much more of an influence in terms of how the world economies are functioning. And I think it's important to have a little bit of exposure into that space. Up until now, I haven't had that much exposure to it, but recent events have kind of made me kind of pique my curiosity and have made me consider, maybe a good time to start looking at the space. Specifically, we have a situation right now. We have a lot of trade tensions, a lot of tariff trash talking going on, and also we have a world where interest rates are rising. So a lot of liquidity is coming out of emerging markets into other parts of the world. So it's been putting a lot of pressure on emerging market stocks and financial assets. And so, as an investor, we want to invest in things that are cheap, and we want them to grow and retain some value on it. So right now, emerging market stocks have come under a fair bit of pressure, and so I'm thinking, you know what? Maybe I may want to start building a position in that area and getting some more exposure to it. Now, right now, in terms of analyzing individual emerging market kind of stocks, I just really don't have time for that right now. So I figure the best way to get that exposure is by buying a basket of companies. And I can do that in a low-cost way using exchange-traded funds or ETFs. So what I'm going to do here is I've kind of identified 4 of the more popular emerging market ETFs out there. And I'm just going to do a quick analysis, a comparative analysis of each of these ETFs and compare them amongst a set of criteria. And for those of you who have taken my everyday investing course, you'll know what these criteria are quite well. And so let's just jump in and let's just take a look at these ETFs and see, which ones are ones that maybe I may want to consider for my portfolio if I were to decide I wanted to, get some exposure to this space. So I got 4 ETFs here, and essentially they're represented by 2 companies, Vanguard and BlackRock, which sells the iShares products. So I'm going to take a look at 2 different Vanguard ETF products, and I'm going to look at 2 different iShares ETF products. Let's just take a look at the Vanguard stuff first. So the first one I want to take a look at are the Vanguard Emerging Market ETF, which is ticker symbol VEE, and it's sold primarily in Canada. It's a Canadian domiciled ETF. And then there's the VWO, which is the US-based ETF, again, emerging market ETF. So let's look at the Canadian one first, and then we'll take a look at it and compare it to the American one. Now, the key thing you got to understand about the Canadian version is it's essentially the same ETF. It's constructed in much the same way as the American version. So it kind of piggybacks the US version. Now, in terms of how it's constructed, so one of the first questions we always ask when we're evaluating ETFs is the investment strategy being incorporated and actively managed? Is it actively managed or is it passively managed? Is it a portfolio of stocks or a basket of stocks that are, somebody's picking specific stocks, or is it a portfolio that's trying to copy or mirror a broad-based market index? So with the VEE, it's essentially passively managed, and it's both. And I'll just might as well do the U.S. one too. It's also a passively managed, which makes sense. It's the Canadian one is piggybacking the American one. Both portfolios, both ETFs are tracking the FTSE Emerging Market Index. So it's passively managed, tracking a broad stock market index. Fees are another consideration we have to factor in when we're evaluating ETFs. So the Canadian version, their management expense ratio, or MER, or just their costs of owning this ETF, come in at 0.24%, which is pretty decent. The American version, however, though, is actually cheaper. It comes in at 0.14%. So these are pretty cheap on a cost basis. These seem to be they're really cheap. Another criteria we need to evaluate the ETFs by is liquidity. How much trading volume do these products generate on the market? Ultimately, we want to find ETFs, invest in ETFs that trade a lot, have a lot of liquidity in the marketplace, because if a stock or an ETF trades a lot, has a lot of trading volume, that means you're going to get better price discovery. The prices are not going to be very volatile. And when you buy or sell ETFs, you're going to get a pretty good fair price for them. So the Canadian version trades on the Toronto Stock Exchange. It has, on average, trades about 51,000 shares a day. The US version, on the other hand, trades much, much higher. It trades 14 million shares a day. So it is an extremely liquid portfolio, extremely liquid stock from that side. So you're going to get really good price discovery, and you're going to get a fair price for it if you decide to buy or sell the ETF. The other thing we also want to look at, excuse me, is the portfolio makeup of it. How is the portfolio constructed? Is it concentrated into a handful of stocks or sectors, or is it very broadly diversified? Ultimately, we want to buy a very broadly diversified portfolio, again, to protect ourselves from whatever market volatility, or if the markets were to tank and there'd be all kinds of wackiness going on in the market, that the ETF would be able to manage that volatility effectively. So when we looked at now I said with the Canadian version, essentially it is copying the Canadian version is essentially mirroring or copying the American version. So when we look at the American version, it's better to just take a look at the American version and to get a sense of what the stock is. So a couple of characteristics of their portfolio. It's interesting that there is no Korean. Korea is not represented in this ETF. It invests in individual stocks, so it's actually buying stocks. It's not buying, like, using derivative products to get kind of, simulate a kind of exposure to the sector. It has in the portfolio almost 4,000 stocks in the portfolio. And if you were to look at the top 10 holdings, they represent about 20% of the total fund. So it's, when you've got 4,000 stocks and 10 of the top 10 of them represent 20%, which means the other 3,990 represent 80%. It seems to be a very very diversified. There's not a lot of concentration in the portfolio, and as investors, that's what we want to see with the portfolio. So the Canadian version, again, essentially is copying this, and so what they do is they essentially invest. They just basically buy the VOW, and which essentially owns, essentially has that makeup. So and the ratio of that, again, and a lot of the ratios and the amount of companies that are owned within here are very much the same as here. So the big difference really is when you buy the Canadian version is that you're paying in Canadian dollars, and obviously the US version you're paying in US dollars. And I'll talk about the currency aspect of that once we kind of go through all of this. Now the final criteria that I want to look at when we look at ETFs is tracking area. How does the performance of the ETF compare to the broad market that it's trying to replicate? Is it tracking very closely to the return of the broad market, or is it lagging behind it? And so, for example, if the FTSE index were to be up 20%, we would want the ETF to generate as close a return as possible to that 20%, adjusting for costs and miscellaneous things. Otherwise, if if the ETF had a very low tracking error, or a very high tracking error, sorry, then you're essentially leaving money on the table, and it's kind of like waste that's just there and is not really ultimately great. As investors, we want to get as much return as possible. So when I looked at the tracking error for the two Vanguard funds, the Canadian version had a tracking error of 0.26%, which is pretty good. So, you're getting very close to the return of the broad emerging market index with the Canadian version. So I thought that was pretty good. But then I looked at the US version, and their tracking error is 0.13%, which is even better. It's half the rate of the Canadian version. So you're getting really, really excellent performance from the American version compared to the Canadian version. Now, as I said, the Canadian version, there's about $823 million dollars in assets there. The U.S. version has $84.5 billion dollars of assets. So the U.S. version is a much bigger fund. It trades. There's a lot of liquidity behind it. It's an extremely popular ETF. The Canadian version for a Canadian ETF is also pretty solid and pretty popular from that. Now, the key differentiation, though, is when you buy the Canadian version, you are paying Canadian dollars. And obviously the US version, you're paying US dollars. So that's there's currency risk. So if you're up here in Canada, it may be a better deal to buy the Canadian version, and there's actually some other benefits of buying the Canadian version. But if you're in the US, for my US listeners and viewers out there, you're obviously not going to buy the Canadian version. You're going to buy the US version. It's a better deal for you from that sense. You don't have to worry about the currency issues or anything like that around it. So those are that's the Vanguard ETF, emerging market ETF product, the Canadian version and the US version. Now, I want to take a look at another popular emerging market ETF, which is sold by the BlackRock company under the iShares line, and that's the iShares Emerging Market ETF, ticker symbol EEM. Again, it's a passively managed portfolio. It follows a broad-based index, but it's a different one. It actually follows the Morgan Stanley, the MSCI Emerging Market Index, which is another broad-based common market index. In terms of fees, the fees for the EEM come in at 0.69%, so it's much higher than the Vanguard products. In terms of liquidity, I talked about liquidity. The Vanguard trades 14 million of shares a day. The liquidity of in terms of trading volume, the EEM trades approximately, on an average, trades about 74 million shares a day. So so if you thought the Vanguard was a busy product, trades a lot. The iShares ETF trades even more. From that perspective. The fund itself comes in. It's about a $30 billion fund. So again, it's a huge fund. And you got to obviously pay in US dollars. It's a US dollar based account. What else? In terms of looking at the portfolio, now what's different between the iShares and the Vanguard is the iShares has Korea exposure to Korean stocks in here. So that's a big difference. The Vanguards don't have exposure to the Korean market. So if you're a type of person you want to have, Korea is one of the big economies in the world. So if you want to have that exposure in there, then the iShares product will give you that exposure. The Vanguards won't. So if that's something of a sticking point with you, then there's a differentiation there. Just like the Vanguard, It invests in individual stocks, but not as many. It has 800 stocks in its portfolio. And the top 20 represent about 25% of the total portfolio. So it's a little bit more concentrated compared to the Vanguard one. And in terms of tracking error, the tracking error for the EEM, for the iShares product, comes in at 0.48%. So it's a much higher than the Vanguard and both the Vanguard products from that side of it, but still pretty low. It's not, excuse me, it's not a showstopper in that sense. It's still extremely low for an emerging market ETF, for a foreign-based, international-based ETF. So that's kind of good. It's a good thing to see. So that's the iShares EEM emerging market. And so finally, the last one we're going to take a look at is another iShares product. It's from BlackRock. It's called ticker symbol BKF. Now this one's a little bit different. It's a little bit more concentrated than the other ETFs in the sense that those ETFs, the Vanguard and the EEM, have a much more exposure to a wide variety of emerging markets. This particular one focuses investments on 4 companies or 5 companies, the BRIC companies, the BRICS. And that's the name of the product. It's called the BRICS ETF. Specifically, it invests in shares in Brazil, Russia, India, China, and South Africa. So the largest emerging markets. So if you want to have a much more concentrated exposure to emerging markets, then maybe this is the type of product that maybe you want to consider from that side of it. Now, how is it managed? It's essentially it's a very it's passively managed too, in the sense that its goal is to track or mirror the Morgan Stanley BRIC index, which is essentially taking a whole basket of these various countries' stocks and tracking an index. So it's trying to map that portfolio, that exposure. In terms of expenses, the costs on this are a bit high. It's 0.7%. So it's almost comparable to the EEM product and much more expensive compared to the Vanguard products. In terms of liquidity, it trades a lot less. It trades about 14,000 shares a day. So much lower than the other ETFs that we're looking at here. If you look at the nature of the portfolio, again, it invests in individual stocks. And the top 10 holdings in the portfolio represent 34% of the total portfolio. So it is a much more concentrated portfolio compared to the other ETFs. And finally, when we looked at the tracking error for this, for the BKF, it came in at 0.66%. So it's got a much higher tracking error rate compared to the other ETFs. And then finally, I'm going to stick this somewhere. It's a much smaller portfolio in the sense that there's about $190 million in the portfolio. So again, when you're comparing it to the Vanguard and the EEM, which have those are in the billions of dollars. There's those portfolios. The BlackRock is really small. It's a much smaller portfolio, but it might be something that might be interesting to, if you really want to concentrate your exposure in the emerging markets in terms of just exposing yourself to the big economies, the larger economies. The BRICS gets you that, but you pay a higher price point for it, and it's a much lower liquidity product. So here you go. So these are the 4 ETFs that I looked at. We've compared them across a variety of criteria. So if I were to make a decision, okay, which ones would I want to buy? Like which one sort of jumps out at me as something I want to incorporate in my portfolio? So one of my goals is I want to have as broadly diversified and as broadly exposed portfolio of emerging market stocks. And so for me, The bricks, I don't think would really meet my criteria. Personally, if you want to have more concentrated exposure, then maybe that's something you may want to consider. But for me, I probably would not want to have this one in my portfolio, so I'm going to cross this one out right away. So it really comes down to the Vanguard and the EEM. So as somebody who lives in Canada, though, I just want to kind of put this out there for my Canadian friends out there, is the big difference obviously is currency exposure. If you buy the U.S. one, you're getting more currency risk because you have to pay in U.S. dollars. So if the U.S. dollar appreciates, then it's great. But if the U.S. dollar depreciates, then the value of your exposure is going to be lower. So you have that currency risk you kind of have to play around with. So it may not be if you're Canadian. You might actually be better off investing in the Canadian fund because that currency risk is minimized, and also there's also some benefits too in terms of any income that's generated from the fund. You don't have to pay any withholding taxes or fees from that, and the currency side of it too. So the Canadian version, if you're Canadian, I think the the VEE would actually suit your purposes. But anyway, I want to go backtrack because I just want to compare these funds in terms of the criteria. So they're all passively managed, which is good. If I were to look at them from a perspective of cost, the Vanguard ones are definitely much cheaper than the iShares product. They also have a fair bit in terms of liquidity. I would say the U.S. products have a much higher liquidity base, so you're going to get much more accurate price discovery from it. The differentiation also is the Korea aspect of it too. Is the Vanguard does not have exposure to Korea, while the iShares product has exposure to Korea. So it really comes down to do you want to have that exposure or not? And if you want to have that exposure to the Korean market, then you probably would want to go with the iShares from that perspective. They're broadly diversified in terms of the concentration. So, 20 to 25% is pretty decent. Broad-based, they're not very concentrated. And from a tracking error perspective, the Vanguard ones tend to have a much better, more accurate tracking record. So when you look at it, I think for me, I think the Vanguard products seem to be ones that jump out at me as something I would probably want to have if I were to get into have some exposure to emerging market stocks. I think the Vanguard product probably provide a pretty good exposure. Now, whether I would want to get the Canadian version or the U.S. version, it really depends. And the real differentiation, though, is with the Canadian version, you don't have to pay. There's no withholding tax. And on the US version you would have to pay a withholding tax. And so this is really more for my Canadian friends out there. In the US, my US friends out there, this is not really much of a sticking point for you. For you guys, if I were to make a decision, I would probably lean toward the Vanguard US. It seems to be it's a passively managed fund, much lower costs, higher liquidity, and a much lower tracking error. That to me, these seem to be qualities that I think would jump out at me in terms of an ETF that I would be looking for in terms of the emerging markets. For my Canadian friends out there, the Canadian product I think would give you a better bang for your buck in the sense that the costs are lower, you're paying in Canadian dollars, and any income you generate from it there's not going to be some sort of double taxation in terms of withholding taxes on it. So the VE actually might give you a better bang for the buck. Now, if you were interested in having exposure, the only flaw, I guess, is you don't have exposure to the Korean market. In that case, if you're really hell-bent on getting exposure to the Korean market, then the EEM is probably the best way to do it. So it really comes down to your own personal situation, your own personal preference, your expectations for in terms of what you're looking at in terms of exposure. But hopefully this analysis can give you a bit of a framework in terms of how you can go about comparing different ETFs and trying to figure out which one is going to be best suited for your own personal personal portfolio and in terms of helping you meet your long-term objectives for your portfolio. As I said, for those of you who like to listen to things, this video is also available in podcast format. You can find it through Apple Podcasts. Do a search for Sage Investors, or you can find it through my website, sageinvestors.ca. So this has been a quick comparative analysis of emerging market ETFs. Thanks for listening in. Thanks for watching in. My name is Amin Reina of Sage Investors, and we'll catch you again another time. Take care. Bye-bye.